Well, welcome back to the Market Day Report. Janet Atkinson here in the hot seat with you for the markets. And it's time now of day, or actually of the week, that we catch up with Brian Hoops. And he is based out of Springfield, Missouri, and gives us a rundown, of course, of what's taking place in the grain as well as the livestock markets here on this Tuesday's trading session. With that, let's check in with Brian. Brian, how are things going for you today?
Hey, they're going real well. I wish we had a little bit higher prices today, but we do have crop ratings on the defensive in here, markets on the defensive as well. A lot of producers calling and asking about what's going on and why things would be acting this way when you do have some positive news out there.
Were you kind of surprised to see the upside movement that took place in the soybeans during the overnight session following what we saw yesterday?
Well, you know, that was right after the report's release. When it opened at 7 o'clock, we rallied sharply and made our highs, but we started to drift lower from there until we, we're over 30 cents off of our overnight highs now. The soybean market here is reacting to the forecast. And we traded the crop ratings early, and then the rain in the forecast here later in the session, as that is putting pressure against these markets. And we also have not negated those technical reversals that we saw back on July the 11th in both corn and soybeans. And until we take those out, you really don't see a lot of funds stepping in and buying this market. They are more apt to be sellers as they're trying to trade with the trend.
And let's go ahead and take a look at what's taking place in the wheat complex today. Of course, the wheat seemed to follow the lead of soybeans and corn yesterday to the downside. That downside action is continuing today as well.
Yeah, it is. You know, the wheat market here has dropped about 90 cents off its highs in the winter wheat contracts, maybe $1.50 to $1.60 in the spring wheat contracts off its highs. Market's trying to find a price level that's going to stimulate demand. Ever since we've had this rally this spring, we've really backed off on any export sales, especially to Egypt, and with another Egyptian tender last night, the market's trying to find that price level that's going to stimulate some demand for our U.S. wheat supplies, and that's what's going to be needed if we're going to take another leg higher in this wheat market.
All right. Well, Brian, thank you very much with that. Hold on. We're going to talk livestock here in just a moment, if that's okay with you. But in the meantime, let's take a look, starting things off with the corn market in Chicago and what's taking place there at the CME Group right now. We've got the nearby September contract currently down 6 pennies. That is at 3.71 1/4 cents. December new crop corn down 6 1/4 at 3.84 1/2 cents, while March is off 6 1/2 at 3.95 1/2 cents. Over into the soybean complex, as we said, of course, it was down yesterday. Found a little upside strength overnight, but of course came off of that. August currently down 6 1/2 at 9.91. September down 6 1/2. November new crop beans down 6 3/4 cents, but still setting above that $10 mark at $10.03 1/4 cents. And shifting into the wheat market, starting things off, of course, in Chicago. September nearby 10 1/4 on the downside, now 10 1/2 lower at 4.78 1/4. December Chicago wheat down 10 cents. That's at 5.03 1/2, while March is off 10 at $5.26 1/4 cents. And into the Kansas City complex, also downside action there, off a dime for September at 4.77 1/2. December down 10 1/4 at 5.04 1/4 cents. July, Kansas City down 7 1/4 at 5.51. And into the Minneapolis exchange, also downside action taking place there as well. September down 24 1/4. That's at 7.26 1/4. December down 23 cents at 7.35 1/2, and March down 18 3/4 at 7.37 3/4 cents. So it's the nearbys in the Minneapolis complex leading to the wheat markets to the downside. Of course, we're going to turn our attention over to the livestock markets, take a look at what's taking place in the cattle and the hogs. That is coming up next. So, of course, stay with us right here on your Market Day Report. Well, thanks for joining us here for the Market Day Report. As we showed on a bump right there, we have the sugar markets a little bit on the downside today. Lumber on a mixed trade for this Tuesday session. Now, we are joined once again, Midwest Market Solutions, Brian Hoops joining us from Springfield, Missouri. And turning our attention, Brian, over to the livestock markets. Of course, cattle country, they waited a long time last week to get any business done. Of course, that all hinging on the Cattle and Feed Report Friday.
Absolutely, yeah. The cash market pretty non-existent last week, did not have a lot of head being traded. And of course, this week we don't expect a lot of cattle being traded till maybe later in the week, but cash looks softer this week after the big drop in the futures yesterday. I do expect the packers will start to come in here and be a little bit more aggressive, as they did not buy much cattle last week, and they're going to use this price weakness that we've seen in the futures to try and buy inventory at a little bit cheaper money. So we might see a little bit of a bounce here in the August contract. I think August gains against some of these Octobers and December contracts that's when the bigger supplies are going to hit the market. Supplies are actually somewhat tight here right now in this August timeframe, evidenced by this week's show list, which are down from last week and down from a year ago levels, despite the fact we did not have much aggressive cash trade last week.
And, you know, they, as you say, since they didn't move very much last week, they're going to have to make a move here sometime. So this week or next, I suppose, right?
Yeah, I think it'll be a little later in the week. You know, we've got some very hot days here in the next couple days, and after we get past those warmer days, that's when I would look for those cattle to move and limit the death loss. And
speaking of the heat and the dryness drought taking place, I came across something noting the placements in last week's cattle on feed report and talking about the drought up in the upper Midwest maybe contributing to that higher placement number just because folks had no choice but to move cattle to market.
That's exactly right. The cattle in the Dakotas and in Montana, they are moving quickly off of pastures as they don't have really any pasture grass because of the drought conditions. So those are being placed into feedlots very aggressively, and that's why we saw a very strong placement figure. Trade was expecting 6% and got 16% above last year, but it really shouldn't have been a huge shock to the trade because of the aggressive nature of those ranchers in the Dakotas and out into Montana, Wyoming areas.
Well, Brian, turning our attention now over to the hog complex. What's taking place on that side of business this week?
Well, the cash markets have weakened a little bit in here. And if you look at those deferred futures, October, December, we're holding a huge discount to where the August is. And August is already discounted to where the lean hog index is, or the cash index. So the market's anticipating cash is going to fall here. This is a very similar setup to producers in the cattle market this spring when the summer and the fall futures were so heavily discounted to the cash. If you try and sell futures, the futures market may not move lower, but if the cash does, producers haven't really benefited at all. So there's some opportunities, but not in the hedging market. I don't think in the October, December futures. If you want to do some sort of a hedging, contact your packer, do some option strategies, but futures don't seem to be the way to go in those deferred contracts in hogs.
If you would, Brian, before we wrap things up just a little bit, of course, as we've talked, we've got the downside taking place in the grains complex. Talk about that relationship with the livestock markets.
Well, you know, as corn prices get cheaper, it's usually a little bit bearish or bullish, to the cattle market. As we get to cheaper input costs, the feeders will buy cattle a little bit more aggressively, figuring they have cheap corn to run through it. And so we have a little bit better demand on feeders. And, that remains to be seen if we're going to have that cheap corn as we go through the rest of this year. You know, there's a lot of yield estimates starting to come out in the corn belt from 163 to 165, 166, and that would, cut into our ending stocks a little bit, not give us sharply higher prices, but if we get the yields down far enough, if the drought continues in the western corn belt, we'd look for feeder cattle to continue to come under pressure, especially if corn prices increase.
All right. Thank you very much, Brian. We certainly appreciate your input once again. That is Brian Hoops, based out of Springfield, Missouri, with Midwest Market Solutions, joining us. Just a quick rundown of what's taking place in the live cattle and the feeder cattle complex at this hour. Right now, we've got the nearby August up 47 pennies at 114.35. October setting unchanged at 114.40. And in the feeder cattle complex, also some mixed activity there. Nearby down 55, and September up 2 cents at 148.70. So there you have it.
All right. Thank you, Janet.
Yes.